Thank you for joining us today. On behalf of the Tavola Group team at Tavola International, we're really thrilled to have you here to join us on how to start a business in the U.S. as a foreign owner. Expanding to the U.S. market opens doors to new customers, revenue streams, and growth opportunities. But for many international founders, the process can feel complex, honestly, because it is. Today, we'll simplify the journey and provide a clear roadmap for launching a U.S. business successfully. Quick intro, my name is Matt Schumacher. I'm the Director of Tax Planning at Tavola Group, and I'll be hosting today's session. I'm joined today by Gabe Malavolti, our Chief Executive Officer, and together we'll walk you through essential steps foreign business owners need to take to properly form and operate a U.S. business. Today, we'll cover the essential steps for all of that, including entity choice, EIN registration, formation requirements, tax obligations, banking setup, and avoiding common compliance mistakes. By the end of the webinar, you'll have a roadmap to move forward confidently and strategically. Just a quick note, Tavola Group and its employees do not provide legal or investment advice. This session is for educational purpose only. Please consult your own advisor before making business, tax, or investment decisions. A little bit about Tavola Group. Our name reflects our approach. Tavola means table in Italian, and that's exactly how we work with our clients, sitting alongside them during the financial and business conversations that matter most. We combine tax strategy, business planning, and integrated advisory services to help business owners navigate complex U.S. regulations, make informed decisions, and grow their ventures confidently. We know expanding into the U.S. can feel overwhelming, but Tavola International makes it simple. We guide foreign business owners through every step, from choosing the right entity and managing compliance to handling tax registration and setting up banking and payment systems. Our approach is fully integrated, combining accounting, legal, HR, insurance, and finance support. With our multilingual team and extensive experience with international founders, we provide a trusted partner to navigate the U.S. rules so you can focus on growing your business with confidence. Now, I am delighted to introduce Gabriel Malavolti, our Chief Executive Officer and close friend. Gabe brings a deep technical background spanning financial products, insurance, real estate, and advanced tax planning. Prior to joining Tavola Group, he served as an international tax manager at PricewaterhouseCoopers, where he specialized in cross-border business structuring and foreign currency exposure. He earned his Juris Doctorate in Master of Law in Taxation from Loyola University Chicago Law in 2014 and is a CPA, licensed insurance agent, realtor, and financial advisor. A dual Italian-American citizen now living in Puerto Rico, Gabe has a genuine passion for international business and global entrepreneurship. Throughout his career, he has advised countless small and middle market business owners, acting as CFO, legal counsel, risk manager, and strategic advisor. Today, he focuses on helping international entrepreneurs navigate U.S. business formation, tax compliance, and long-term growth strategy. Gabe, it's great to have you here. I'll turn it over to you to guide us through today's session.
Thank you, Matt. And welcome to everybody on the call from all over the world. These are usually more entertaining when we can interact with each other, but today's is going to be kind of me pushing through slides. Please make sure that you are entering any questions you have into the chat live as you have them, and Matt will bring them up when he sees fit. As Matt said, I'm in charge of Tavola Group, have a broad background in law, finance, insurance, accounting, tax, etc. Tavola Group has been a dream of mine for over a decade, almost 2 decades now, to provide cohesive, all-in-one support for businesses across the plethora of services that we offer and or quarterback and manage for you. Opening a business in another country is very daunting. There's a million different compliance steps that you have to take in order to keep your name out of the papers, so to speak, to stay compliant. And today's agenda, we're going to look mostly at the legal and accounting side of things. There's insurance needs and other HR needs, et cetera, that pop up when you have a business. And we'll touch on a few of those today. But generally speaking, your first step is determining what entity structure or legal setup is right for you and your business. We have to go through what accounting and reporting you need. There's various forms of accounting that you can choose from depending on the size of your business, complexity, style of business, et cetera. Payroll requirements are very nuanced by state. direct and indirect taxes, your income taxes, sales and use taxes, et cetera. We do not have VAT here like Europe has, but we have a even more nuanced and complicated system amongst the states. And then the last piece is, your roadmap for getting a company up and off the ground, whether you want to try to do that by yourself or you want to work with a team like Tavola Group. All right, so entity structures, as the world has evolved and international business has evolved, more and more countries are getting on the same page with what structures are possible. We have your general C corporation or a closed corporation in the U.S. that has a flat income tax rate of around 21%. There's different board of governance requirements, reporting requirements, et cetera. It's the most common for companies looking to go public. There's advantages and disadvantages to any structure, so it's important that your facts are kind of brought to the table to your advisors in order to pick which structure is best for you and your long-term plans. The LLC is probably the most commonly set up entity type for small businesses and middle market businesses. An LLC is a nothing from a tax perspective. It's a blank slate. It's a legal liability company, so it isolates your liability. It operates to protect you and investors or shareholders from a legal perspective. Then you get to elect what tax structure you want within the LLC. Generally speaking, for foreign investors into the US, the disregarded entity, which is possible when you're wholly owned by a parent corp or a parent entity, or the corporation are the two more common. There is a scenario where you could elect into a partnership, especially if you have a joint venture that you're entering into the US, or you're setting up an entity in the US and taking on specific US investment for that entity with other shareholders. So those are generally speaking the three that we see. The branch structure is not something that I frequently recommend. It's where you don't have an entity in the US and you're just operating in the US underneath the foreign parent. There's reporting requirements around that. The downside is you're not isolating your liability into that business. It's generally speaking not going to be much more expensive to have an LLC set up, treated as a disregarded entity, if that's the approach you want to go with, in order to isolate your US liability to that US company, so long as we're doing all of the things needed to respect the corporate veil and keep the business assets protected. All right, the general structure that we see is, generally speaking, we see one of two. So we see a foreign-owned parent set up a U.S. company, and that's that. That U.S. company does anything and everything within the U.S. A lot of times, the second structure that we will see is setting up a U.S. parent company, and then underneath that U.S. parent company, setting up various operating companies. Sometimes that's for liability protection on assets and equipment, for example, where you might have an entity that owns real estate, an entity that owns assets, construction, for example, materials, et cetera, and then an entity that employs the people and has the operations. There's not a need to go super complicated. I usually try to recommend simplifying as much as possible in the beginning. It really depends on the roadmap for growth for your organization, how large you plan on getting, how fast you plan on getting there, and the type of business that you're in. There's not necessarily a perfectly right or wrong answer, so long as we are doing what's best for your facts to manage your risk. From a tax perspective, we can have those subsidiaries to the U.S. entity be deemed disregarded, so that there's one major tax filing. Limiting the amount of filings that have to take place is going to save on costs in the short and long term.
So one of the questions that just came in, Gabe, is around subsidiaries. Would it make sense just to create a U.S. subsidiary if they only want to test the U.S. market?
Yeah, probably. So, normally what I would recommend in that situation is let's set up a U.S. subsidiary of the foreign parent, probably an LLC. If you're looking to test, the question is more from an operations perspective. What are you going to put in that entity, if anything? Or are you just going to be running that lean and having contractors and, not having a large presence in the U.S.? Generally speaking, that's your best route. I wouldn't go overboard with setting up a million entities. It usually just leads to more complexities in filings. Okay, so setting up a company in the States. We frequently talk about the states as if it's a whole, and it is a whole, but we have 50 different states that have different rules. And when you are setting up a company, you have to pick which state your company is going to be incorporated in. There's various reasons why you would pick certain states and why you would avoid other states, some of which are tax, some of which are legal. For example, a lot of your large multinational organizations are headquartered in Delaware. The reason is because Delaware historically had phenomenal laws in place to protect businesses. And so when businesses would get sued, they would try to move the lawsuits to the location of their headquarters, which would be Delaware. That's not necessarily the case anymore. There have been a little bit of recent case law, which makes Delaware a little bit less desirable. Still one of the top 5 states probably for incorporation for that reason. From a tax perspective, there are better states to incorporate in than Delaware. It depends on your structure type. The states are going to tax C corps differently from partnerships or from a disregarded entity. Obviously, that's going to flow through to you as the parent. The attorney is going to be able to help you pick which state is best for all purposes, liability, protection, lawsuits, and tax purposes. You then have to pick a registered agent. Your registered agent has to be local within the state that you are filing in. They have to have an address there. They're registered on your behalf, so they'll receive a lot of the mail related to your company. And then we go ahead and file those articles of incorporation or formation, generally speaking, through the state website. Most of the states now have a pretty quick turnaround time. You can pay for accelerated filings, which is usually a day or two. But within 2 weeks, you usually can have your entity established and formed within that state.
I just got a question. All right, if a U.S. company operations are performed in another country by a foreign parent, is the U.S. company required to compensate the foreign parent for those services? If so, are there specific rules or guidelines governing how those service fees or rates must be determined?
Yeah, and we get to that a little bit later in the presentation. So I'm going to table that question, Matt, make sure I answer that before the end of the presentation. But there's a slide later on that talks about some of those requirements.
Awesome.
Okay, the next step after we file a entity, so we have your entity open now. Let's just say it's an LLC or a C corp. We would go and file with the IRS to get an EIN, an employer identification number. This is very straightforward. We use Form SS4. It can now all be done online for the most part. This is required for everything, for your tax filings, for opening bank accounts, et cetera. Generally speaking, you don't have to have a social security number or a tax ID number personally in order to get an EIN for an entity. Pretty straightforward. And some of these slides we'll breeze through. This one is not a breeze through slide. Well, we can talk about it quickly, but it doesn't happen quickly. Banking setup everywhere in the world is a pain. The US is no exception to this. There's been more and more compliance and regulation around getting bank accounts set up, from knowing who people are to where the funds come from. Some banks are more friendly to foreign investors than others. Some are going to try to require in-person visits to get the bank set up. Some are going to try to require a US social security number or a tax ID number. Generally speaking, we can find ways to get around this. It doesn't happen super quick. So in the setup of your business, this is probably the longest piece, depending on the bank that we're able to go to and what information they demand or require. So the compliance team's no fun. It does take several weeks usually to get a bank account open in the States. I know a lot of the world is kind of going in that direction as well. Okay, accounting basis differences. I think we have a few slides on this. Generally speaking, in the accounting world, there's been a lot of progress made on getting GAAP and IFRS onto a similar system. There still are differences. So most foreign investors are reporting their books according to IFRS or a tax basis or a cash basis of accounting. But for purposes of this conversation, let's just say that most people are on IFRS. In the US, you can take a tax basis of accounting, which usually is cash or a modified cash basis, until you hit a certain level of income, in which case you have to switch over to GAAP, and that's based upon your industry as well. The major differences are shown on this slide. So the inventory valuation rules under IFRS, you can sometimes revalue your inventory up. Under GAAP, you cannot. The depreciation methods differ significantly, and this is usually to your advantage in the US. The US has what's called bonus depreciation, or we have depreciation under Section 179, where we can sometimes fully expense an asset the first year we buy it, or expense a large portion of a piece of real estate, for example, underneath accelerated depreciation principles that might not match IFRS. From a U.S. tax perspective, that's very helpful. A lot of times you then have to convert some of those U.S. numbers to IFRS based upon your reporting in whatever country you're from. The tax basis, is what a lot of small businesses try to use if they can. It's usually a little bit more straightforward. Generally speaking, cash in, cash out, and we have to factor in AP and AR, but the GAAP rules are mandatory at a certain size. So these slides, and you guys have access to these slides after this presentation, but this is going to list out some of the major differences. IFRS prohibits last in, first out on inventory, which is a common method in under GAAP. So under GAAP, we can do first in, first out on inventory or last in, first out. It ends up having, depending on your industry, it can have a large impact on your profitability for the year based on what you're paying for your inventory. So in industries where inventory costs fluctuate heavily throughout the year, choosing FIFO or LIFO or weighted cost can make a big difference. The expensing of certain inventory or assets is also, probably more unique under GAAP, and something that we would have to look at on a fact by fact basis for your individual companies. Fixed assets and balance sheet treatments is probably where the biggest differentiator comes in for tax planning purposes, as it relates to buying inventory, buying assets, buying real estate, et cetera. The depreciation rules are going to be significantly different, and they vary. We've had massive tax reform multiple times over the last decade in the U.S., which has changed it. Some tax professionals aren't even keeping up with it here in the U.S. So definitely something that you wouldn't want to try to keep up with necessarily, but make sure your advisor is on top of it because, for example, bonus depreciation, which allows us to take a heavy amount of depreciation upfront on certain assets on the federal level, is very powerful. Not all states follow it. So you might be able to take, let's just $100,000 bonus depreciation, and then at a state level have almost all of that denied. So you might be paying at a heavier rate in the state versus the Fed, for example, depending on which state you're in, where the assets are, where the income is generated, state apportionment rules, et cetera. Payroll stinks. There's not really any way around it. It's really a pain in the butt for everybody who has to deal with it. There's just a lot of compliance around it. There's federal compliance, there's state compliance, and then there's local compliance. The options within the states of which softwares you go with. There's a lot of software providers, there's PEOs, and we'll get into that, and I think some of the next slides, but you have to withhold federal and state income taxes on behalf of the employees. You withhold Social Security and Medicare, and those percentages shift at different income levels. So high income earners, for example, hit a certain cap, and then the percentages shift down. You have to set your payroll schedules based on state laws. Also, I'd say very much from an employee happiness perspective, more in line with industry standards. So some industries are every other week, some industries are weekly. Some will shift to monthly, but generally speaking, every other week is the standard. And some industries, it's every week. There's different costs associated with that from your payroll providers. You have to offer new hire documentation. The employment law in the U.S. is state by state. So 50 states, if you're coming in and you plan on doing business in a bunch of different states and having employees all over the place, you need to, work with, or at least have a basic understanding of what the various rights are of the employees in those states. Some states have very, very differing rules and employee rights than other states, in particular as it pertains to sick leave or maternity, paternity leave, et cetera. And the payroll providers generally can give you basic information on that, but an employment attorney sometimes is worth consulting just to make sure everyone's on the same page. One of the big differences between the U.S. and a lot of other countries in the world is we have at-will employment. Severance rules are lax. Non-competes and non-solicits are by state as well. So there's a lot of complexity around adding employees within the U.S., not just on the payroll compliance piece, but on the employment law piece as well. Okay, so for payroll tax setup, you have to have your EIN, which we already set up for the business in the first part of this presentation. You have to register with your federal payroll accounts with the IRS. Then there is state labor and tax departments in your state. You have to obtain local tax IDs sometimes, depending on where you're doing business. And then you have to maintain accounts for unemployment and withholding taxes. Generally speaking, your software providers are going to handle a lot of this. They're just going to need certain information from you. We have, and this slide shows the percentages. We've already kind of talked about it, but on the federal level, we have Social Security, Medicare, federal unemployment tax, and then the states kind of all have their equivalent. So we call it FUTA and SUTA are the two main ones. SUTA is your state unemployment tax accounts. That ranges. So some states are as high as like 5%, some are under 1%, and a lot of them have a sliding scale based upon the wages that people are paid. So generally speaking, not something that you're going to have to know or remember. It's just has to get set up properly on the front end, and it comes out on reporting obligations to your employees. Okay, so there's do-it-yourself softwares. I do not recommend do-it-yourself softwares for foreign investors into the US. I would go with a PEO option or a payroll provider. I don't love PEOs. They can simplify things. There's downsides as well to PEOs, which we can talk about, offline if anyone has questions about PEOs versus just generally service providers. PEOs are professional employer organizations where they literally employ your employees for you. So they will have payroll filings that have hundreds or thousands of companies on them, your company being one of them. The IRS recognizes it as a third-party relationship where they are the legal employer, but the employees are then farmed out to your company. They also will procure your work comp insurance, which we don't have that listed here, but whenever you have employees in the states, most states require that you buy workers' compensation insurance. Sometimes the states are the providers of that work comp insurance, so you procure it through the state. And sometimes it is, most of the time, it is procured privately through a insurance broker to a insurance carrier. So adding payroll does add some complexities. My advice is you're generally speaking better off hiring a payroll provider who will then work with a software company for you. For example, Tavola Group will work with ADP to do our payroll filings through ADP for a lot of employers, both domestic and international.
One question came in around the PEO is if they plan to hire in multiple states, is a PEO required?
No, definitely. A PEO is never required. It can simplify things and make things easier for you on the front end. So there are some advantages to a PEO. And a lot of times what happens is people will join a PEO as they're testing out the US or until they get to a certain size, and then they pull their employees out of the PEO and then have them directly employed. To give you an example of one of the complexities, PEOs have to go and procure work comp insurance for every industry that they represent. They usually aren't getting the best rates for people because they might represent 20 or 30 or 50 different industries. And the way that workers' comp insurance works in the US is that your industry is going to dictate which carrier is best for that work comp code. So that's one of the things we run into frequently. Another big issue is that your filing is mixed in with a bunch of other filings. So if you have an issue with your payroll filing, it can be a pain to amend it or to get any answers on what's wrong. Happens all the time. We just had in the States during COVID a tax credit program, which was based off of payroll filings. And anybody who worked with the PEO, it was a nightmare because the PEO just had too much volume in order to handle that tax credit program. So I don't want to scare people away from PEOs. I just personally am not the biggest fan of them unless you're trying to just simplify and you don't care if you're going to lose a little bit of money in that simplification process. Then they do serve their purpose. When you onboard an employee, there's two forms, I-9, which is verifying the person you're hiring is who they say they are, and the W-4, which is related to their individual tax withholding rates. You generally speaking would send a offer letter and an employee handbook. Not every business is great at complying with those two rules, but generally speaking, those two are highly advisable to send official offer letter and have an employee handbook for your company, which lists out the rules within your company. This is important for managing and holding employees accountable to your culture. So for example, if you want to mandate that certain behavior is not allowed in the workplace, you have to have that in the employee handbook. If there are certain things that you're going to require or the state requires from you, you put that in the employee handbook. For example, in the state of Illinois, we have to do a annual sexual discrimination, anti-harassment policy video training every year. So that's something that the state's going to require, and every state has different requirements. Generally speaking, those are put into the handbook. What your paid time off, holiday policies, etc. Generally, that would all be in your employee handbook. And then if you have any benefits that you offer, and this is a big difference between Europe or South America and the US, but our benefit packages are pretty easy to research. You don't have to offer benefits when you're at a certain size. Once you top a certain size, there are certain benefits you do have to offer. Health insurance being the big one, it's super expensive. Most small businesses aren't offering it until they hit a certain scale because they just can't afford it. It's a cost per employee, and you can structure it a bunch of different ways. You can pay for just the employee, you can pay for part of the employee, you can pay for the employee's family, et cetera. So what's required there is going to be based on your facts and circumstances. It isn't the same for all businesses. We do have certain rules around discrimination. So if you offer certain benefits to certain employees, a lot of times you have to offer them to all the employees. Retirement plans tend to be defined. Contribution plans like 401k, where people are putting aside money, a lot of times the employers will match. So if I put in money, an employer will match up to 3% of my total salary or something of that nature into the 401k. So we can help with consulting on all of that. There's generally speaking different service providers around the 401k, around the health insurance, and around the employee handbook creation.
The question, I think you kind of answered this, but I want to just restate it. Do you have to offer benefits and PTO when first starting out in the U.S.? Is there a way to avoid expensive benefits?
Yes. So you do not have to offer benefits when you first start off. If you're starting off with, 1 or 2 employees or no employees and you're just doing contractors, the US has specific law around what makes an employer versus a contractor. So if you're starting off in the US and you just want to test the market and hire a few people as contractors, that definitely has less requirements. Once you have employees, or what we call W-2 employees, because that's the form they get at the end of the year, you don't have to offer benefits. There is certain time off that you have to offer, not paid time off necessarily. So it's going to depend on your state. It's going to depend on federal law and the state, but we have what's called the FMLA. The FMLA dictates that when somebody, for example, has a child, that you have to be able to offer them a certain amount of time off unpaid. So we do not have a mandatory paid paternity or maternity leave, for example. Each state might have a different rule around that, but one of the things that we would look at is where you're incorporating, why you're incorporating there. Are you going to have contractors or employees, and what your goals are for the next 3 to 5 years on ramping up, assuming we have success in the US marketplace.
The other part of that question is around federal holidays and religious observations for things like that.
So there is federal holidays you have to give people time off for, right? And so I forgot how many there are, but they're less than Europe, for example. Generally speaking, it follows a lot of the Christian holidays, Easter, Christmas. We have Thanksgiving, Memorial Day, Labor Day. There's a few others. So you're not allowed to make people work on those days, depending on your industry or what they're doing. There's plenty of businesses that stay open on those days. For example, restaurants. So, there's federal holidays, but they're not mandatory for certain job types. Federal direct taxes. This is generally speaking your income taxes. So there's different requirements, different income tax levels based on your entity type. C corps are closed entities, meaning the entity itself is going to pay the tax. Partnerships, the profit and losses will flow through to the partners, and the tax is paid for at the individual level. There's different filing requirements, the 1120, 1065, et cetera. Not anything you necessarily need to know, but the most important part is what we talked about in the beginning, which is making sure we're picking the right entity structure for your current goals and then your long-term future goals as well. It is possible to change entity elections between a C corp or a partnership, et cetera. There's tax consequences to that down the road, though. So we want to make sure that we're trying to pick the right entity structure up front, so we don't have to try and make an election change down the road and have negative tax consequences. The returns are due depending on what type you have, what type of entity you have, either March 15th or April 15th. There are extensions available for the filing itself. However, the taxes are still due at either March 15th or April 15th. So if your financials are done, the recommendation is always to pay the tax bill, or at least an estimate of the tax bill, and the filing itself can get done down the road. Sometimes there's a couple pieces of information missing, or for whatever reason, the filing can't get done until September or October, which are the next filing deadlines. But generally speaking, businesses are paying estimated taxes throughout the year. So people are paying on a quarterly basis as the year goes on for what they think their tax bill will be down the road. And your accountants usually help with calculating all of that. This slide is loaded. State and local should be like a whole 4-hour presentation on its own. It's really messy. Each state has different rules. Each state has different operating systems. Every state seems to have terrible software and websites. We generally speaking want to try to avoid filing in multiple states. So to the extent we can avoid filing in multiple states, we try. Once we file in a state, then they want to have you file in that state into perpetuity, which isn't ideal. The U.S. uses something called nexus to determine whether or not you owe tax in a state. The nexus rules somewhat common sense, but they're muddy. And really it comes down to how much presence do you have in that state? How much volume of business are you doing in that state? Do you have employees in that state? Do you own real estate, or do you have assets in that state? There's been a lot of changes to this. There will probably continue to be annual changes to this. Amazon and drop shipping really changed a lot of things as it pertains to state and local taxes. So this one is something that if you're going to plan on doing business in multiple states, you have to work with a professional. Otherwise, you're going to mess it up. It's too complicated. Sales and use tax. Generally speaking, I'm just going to focus on sales tax. You guys can Google use tax. But sales tax is going to be triggered at various volumes or services. Every state deals with sales tax differently. Some states will tax services. Some states just tax goods. There's going to be local taxes on sales sometimes. So the first step is determining whether what you're doing even needs sales tax as a component. Sometimes the service you're offering, maybe half of it requires sales tax and the other half does not. Highly dependent upon your state. Economic nexus, this is a little bit misleading. It depends on your state rules and local rules for at what point it's going to be triggered. You have to register in each state. So this is like a heavy compliance lifting. If you're going to be doing business in a lot of different states, there's registrations in every state, sometimes in a bunch of different counties within that state, in order to remit and pay sales tax.
Do you have to do that on a monthly or quarterly basis, or can we just wait to end of the year to take care of the sales?
You want to do it on a monthly or quarterly basis. It's also going to be dictated by size, volume, service type, and state, but you want to stay on top of it on a monthly basis because it's an overly burdensome task. You want to do it live, basically. Okay, so this is to answer that question from earlier. We have international tax requirements. There's also international, I can call them finance requirements. The OECD has been pushing hard the last 20 years to eliminate a lot of international tax planning, like the work I used to do at PricewaterhouseCoopers, to close loopholes, basically. And a lot of that comes down to information reporting, knowing who the owners are. Like as simple as that sounds, is it was actually like a giant pain figuring out who the owners of various subsidiaries and control groups are. We have to file a 5472 in the US. And one of the things that really gets analyzed now, this really came about in light of the OECD talking about base erosion, profit shifting. So when you're taking money from one country and you're moving it to another, why are you doing it? And is it at an arm's length? Like that's the basic summary of this. So when you have services being performed internationally, or you have IP arrangements, intellectual property arrangements internationally, why are you moving money from a high tax jurisdiction to a low tax jurisdiction, or vice versa? And the general rules is that we want to make sure that that transaction is at an arm's length. So if you have a foreign parent providing services for a US subsidiary, it's fair to charge that subsidiary for those services and to have an arrangement where money is moving from the US to the foreign parent. We just want to make sure that that arrangement is an arm's length transaction, fair services. There's a little bit of profit in there. We're not doing things at a loss, et cetera. We want to make sure that any cross-border transactions have a financial transfer pricing study done on them, essentially. Okay, so the 5472 is required. There are stiff penalties for not doing the filing. Cross-border payments have certain withholding triggers. We always go to the tax treaty first to see what the tax treaty is. Most countries that are investing in the States have a robust double tax treaty with the U.S. The transfer pricing documentation that goes along with what we're just talking about, where anytime you're moving money across the border, you want to make sure it's documented. Why? Even if it's a loan. This is another big push recently, is if one country is loaning money to the other country, we want to make sure it's properly documented as a loan, that there's proper interest charged, et cetera. Otherwise, it's going to be deemed an equity investment, which can muddy the waters on reporting obligations, et cetera. Okay, a lot of these are state-based indirect taxes. So various states might charge taxes that other states don't. Usually if a state has a low income tax rate or no income tax rate, they make it up with other types of taxes. There's taxes on business personal property. There's taxes on equipment sometimes. There's what's called franchise tax or minimum tax that you kind of have to pay. This is largely for flow-through entities, not necessarily always for C Corps. Local business registrations, that's not a tax, but it basically operates as one. If you have your headquarters in a county or a city, a lot of times the city and the county might have a payment you have to make to them every year, and registrations you have to make to them every single year. Annual reports and filing fees are usually at the federal level. They're not steep. They do have to be done every single year in order to be in good standing in the U.S. And then the compliance requirements in terms of what filings are required from a tax perspective are going to be different based upon your state. So your state might have a business personal property tax filing that's due in the middle of summer, and other states don't have that filing at all. So your accountants or CPAs will be able to help you with that. All right, final steps, and then we're at time if anyone has any other questions. But generally speaking, there's a lot of red tape just around making sure your company is getting properly registered with all of the various government bodies, right? There's the IRS, there's the state, there's your local municipality, county, or city. You want to make sure your payroll is all properly set up. You're confirming all of your reporting obligations, some of which might not be tax related, but more so information reporting. The bank cares about that stuff as well. There's going to be various deadlines throughout the year, some of which are extensions on filing requirements, but not on paying requirements. And then your long-term U.S. tax planning strategy. So within the U.S., very complicated system. If you have a very concrete plan you want to try and execute, it makes it easier to implement a tax plan up front to mitigate your tax exposure in the U.S. There are various rules that allow us to, kick the can down the road on taxes, such as bonus depreciation, which we briefly touched upon earlier. And then there are certain rules which maybe allow you to not pay tax altogether on certain transactions. So that's a complicated piece. The tax tail should not wag the dog, though. The more important piece is that you're getting access to one of the most robust, markets in the world, and to be able to do that as a foreign investor and enjoy the country you live in while still making money in the U.S. We want to make sure we're setting things up so that it's as headache-free in terms of entry into the U.S. and starting of your operations.
All right. Well, thank you all for joining us today and for your all the questions. I think this is great. There's a very active chat going on today. To continue the conversation, Tavola Group offers complimentary consultation to help foreign business owners. There is no cost, no pressure, just guidance to help you expand confidently into the U.S. You can schedule your session via the link in the follow-up email or contact us directly at tavola.group. This webinar is being recorded and will be available soon on our YouTube channel. On behalf of Tavola Group and our entire team, thank you again for joining us. Appreciate your time, Gabe. This was very helpful.
All right. Thank you, everyone.